Traders, I want to take a look at the recent sector rotation that's happening in the markets. And I also want to get into some opening trades due to that and then make some trade adjustments on some other trades. So first, let's talk about the sector rotation that's happening. And also I want to talk about oil. So with the sector rotation that's happening, what we're starting to see is that the tech sector is now becoming weaker while the financials are becoming stronger, so we want to make some trade adjustments, and I also want to put in a new opening trade for QQQ. So looking at the chart for QQQ, what are we seeing here? Fundamentally, people think that this is now overvalued, went through, filled this gap, and it's going through an equilibrium pattern. So people are starting to get out of tech for good reason, because they think it's overvalued now, and it is grossly overvalued, and it's starting to form this technical equilibrium pattern. This is an example of what that pattern would look like. It's essentially a tightening range. This is usually what happens after you lose an uptrend or after you lose a downtrend, is that you don't just reverse completely. You tend to go through an equilibrium pattern like this. So it's going to go through an equilibrium pattern. I think it will see slight downside, and then it's going to chop sideways, and then from there it's either going to break bullish or bearish. So what's the trade for that? I want to go ahead and I want to put on this broken wing butterfly. I want to be long the 228 put, short the 225, short two of those, and then long one 219 put. You just have $1 per share worth of risk right there. Put that trade on right there. It's already down pre-market, but I want to see that trade go through right there. And you have no upside risk. If it just keeps on going higher, if it just chops higher from here, you have zero upside risk. So I like that trade going into it. The only risk they have is to the downside, and it's only $1 risk to the downside. And you can make any trade adjustments you want to get rid of that dollar worth of risk. You probably sell call spread against it, and then slowly lower the call spread if it keeps on going down more than what we expect. So that's the first thing. Second thing is KBE. So on KBE, everybody's trying to pile into the banks because people are starting to see the banks as a top fish play, or excuse me, as a bottom fish play, because they've been a lot weaker, and they should be weaker. But people are looking at these banks that are 5 times earnings and saying that it's a good buy. They're wrong because it's a value trap, but we still have to accept that the market's probably going to go up on this news. But it's a value trap because just because something's trading for 5 times earnings doesn't mean that's a good company to buy. And the earnings may not be high quality, and the earnings may not be good, even though it's trading for 5 times earnings. That's the thing with the banks. But retail has not seemed to understand that so far. So on KBE, we want to make a trade adjustment with our older trade that we had. So this is under a new trade based on an older trade that we had up here. You can watch the last video about that trade. But here's what we want to do. We want to sell a put spread against it. And so when you sell a put spread against a call spread, you have no extra risk. In a put spread, on a call spread, it's just an iron butterfly. But if I'm selling a call spread right here and I'm selling a put spread right here, either the market goes up and it tests my call spread, or it goes down and it tests my put spread. It can't do both at the same time, so you have no extra risk. And then you could use some of the premium collected to go long the 38 calls, just naked long, no spreads right there. We had a similar thing with XLF. We shorted naked call. So now we're going to go long 100 shares of the underlying and buy a 26 call. And so turn into a covered call by going long 100 shares of the underlying and buy a 26 call, June 12th expiration. Expiration for the trade adjustment up here, where we're turning it in, where we're adding a front spread on the call spread. Should not cost you any extra money to do this. Your broker should recognize that it doesn't have any more risk, so it doesn't cost you any extra money to put this trade on. And same thing, June 19, 2020 expiration. And those are just the trades right there, so we can adjust to the sector rotation. Along with that, all I need to say is that that's all I have right now for today. It's a quick video. All you need to remember is that bulls make money, bears make money, the pigs get slaughtered. And that's an old adage, but it's a true adage, because even though we were wrong on the direction of the underlying, we were still able to make money by doing these trade adjustments. The only way you wouldn't make money is if you were in that category where you were a pig, and that's why they often say pigs get slaughtered, because they don't make money because of the way in which they trade. So it's not market direction that matters, it's the strategy. And then also, quick look at oil, CLN 2020, front month oil. I had said a while ago, oil was actually reaching its bottom, somewhere around, I'd said this when oil was just about, I think a bit lower than that, right here. That oil would go up, but it would go up irrationally because essentially what was happening in Cushing, Oklahoma was that you had glass. It's like having a glass of water that is full. You cannot pour any more water into that glass of water that is full. That's what started happening in Cushing, Oklahoma, and that's why the build was actually starting to shrink. And I eventually said that we would get to a point at which the build would turn into a negative build or a withdrawal, and that's what's now started to happen. So I think we can have a top fishing play right here, short somewhere up here, put a stop loss right before the gap right here, and have a top fishing play, because I think now that irrationality has gone out of it, and I would actually use, instead of using July 2020, go out another month, use August 2020, but short right there. Another thing you could also do is that you can use time spreads on the August-September time spread. That's another thing right there that you could do. Go ahead and short the August along the September, so do a short time spread right there, or just go out naked short oil. But I don't recommend using the ETFs or anything of those sorts right there. Another thing you could do is use the oil tankers to do that. But I think what's irrationally happening is now gone after we saw this double top right here. I think that now it's gone. But initially we did have that, and I was telling you guys at the bottom that the builds were going to get smaller. We're going to have a withdrawal of oil in Cushing, and we did eventually have that. It was irrational though, because if you have Cushing's completely full, you can't add any more oil into there, so you can't have a build. That's essentially what happened right there. Other than that, if you guys have any questions, just ask me. Make sure you guys keep your notifications on, because these trades move a lot. In 24 hours, a lot of these trades are going to have moved completely, so it's good that you probably watched this video within a couple of hours of it coming out. Other than that, go ahead, as I said, notifications. If you guys aren't already subscribed, 2/3 of our viewers are not subscribed. We have information coming out like this all the time. Give this video a like, and go ahead and drop a comment, whatever that comment may be, for the YouTube algorithm. Other than that, thank you for watching, and we'll see you next time.